Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. A leveraged buyout, or LBO, is a way to buy a company mainly using borrowed money, where the assets and cash flow of that company often back the debt. While private equity firms usually carry out LBOs, management teams or other companies can also make these deals. The goal is to boost the returns on the investor's equity by using debt, so they don't have to put in as much upfront capital. Over the years, LBOs have been important in global markets, with famous deals like the RJR Nabisco buyout in the 1980s, and many others more recently in industries like healthcare, technology, and consumer goods. But whether an LBO works depends on how feasible the deal is, which means carefully looking at financial models, risks, and how the business runs. This discussion will go through what makes an LBO model useful, how to build one, look at real-life examples, and weigh the pros and cons. It also ends by talking about when an LBO is a good and lasting choice. At the core of any LBO model is checking if a company's steady cash flow can handle the debt, making sure debt payments are manageable even with safe estimates, and having a strong plan to create value. This helps investors decide if buying the company with mostly debt will give them good returns. The key point here is that the exit of an LBO must deliver a strong internal rate of return, or IRR, for the equity investors involved. Unlike traditional valuation methods like discounted cash flow, an LBO model is focused primarily on the returns to equity sponsors rather than just the intrinsic value of the business. Practically, an LBO model shows how a company can be bought using limited equity capital, which means investors can control large assets without a huge upfront equity investment. This is especially useful for private equity firms managing many investments. It also helps corporate acquirers and management teams make better decisions by clarifying the optimal amount of debt, understanding how cash flow holds up during downturns, and gauging sensitivity to interest rates and leverage. The high leverage used in LBOs enforces financial discipline, requiring management to tightly control costs, improve efficiency, and focus on cash flow, which often boosts profitability. Additionally, LBO models serve as a valuation benchmark during mergers and acquisitions. If the price sellers ask keeps investors from earning acceptable returns, the deal might not work. Finally, building an LBO model involves a series of structured steps, which, while they can vary in complexity, follow a consistent process. We start by determining the purchase price using an enterprise value multiple like EV to EBITDA, while also factoring in transaction fees such as legal, advisory, and financing costs. If management chooses to reinvest, equity rollover is considered, along with the mix of financing sources, whether debt or equity. This purchase price then forms the basis for the leverage setup and expected returns. Next, the sources and uses of funds table shows how the acquisition is financed and where the money is applied. Sources typically include senior debt, mezzanine financing, and equity contributions, while uses cover the equity purchase, refinancing, existing debt, and transaction fees. This ensures everything is balanced and consistent. Finally, operating projections are made for revenue growth, EBITDA margins, capital expenditures, and working capital needs. These are usually conservatively estimated compared to management's forecasts, reflecting a focus on protecting lenders and equity sponsors from downside risks. A detailed debt schedule is essential because it breaks down key elements like interest expense, mandatory amortization, optional prepayments, and debt maturity. This schedule forms the basis of the core feasibility test in an LBO, as it shows whether the company's cash flows can cover its debt obligations. If the cash flow falls short, the deal simply won't work. Next, the cash flow waterfall explains how free cash flow after debt service is allocated. It determines how much excess cash can be used to pay down debt, what dividend capacity exists, and the liquidity buffer available. This waterfall illustrates how value builds over time by reducing leverage. Finally, the model concludes with exit assumptions, typically after 3 to 7 years. These are often based on an exit enterprise value to EBITDA multiple and the remaining debt balance. Equity returns from the deal are measured by internal rate of return, or IRR, and money-on-money multiples. An LBO is generally feasible if it can meet the target IRR for investors under reasonable assumptions. It's important to remember that feasibility involves more than just the headline returns. Thorough stress testing and risk assessment are necessary to ensure the model's reliability. When considering industries for leveraged buyouts, those with stable cash flows, such as utilities, healthcare services, and software maintenance, are ideal because they offer recurring revenues and predictable demand, reducing. The ability to take on leverage is critical, but it must be balanced carefully. While more debt can boost returns, it also raises the chance of bankruptcy. To assess this, we analyze key metrics like debt to EBITDA ratios, interest coverage, and we run downside scenarios simulating revenue declines. Sensitivity and scenario analysis is also a vital part of the process, testing how the model performs under conditions like lower revenue growth, squeezed margins, increased interest rates, or reduced exit multiples. If the returns stay strong enough despite these challenges, the LBO is considered robust. Real examples illustrate these points. While the RJR Nabisco deal in 1989 showed both the potential and dangers of heavy debt, as the company faced intense pressure managing interest payments. On the other hand, Blackstone's purchase of Hilton Hotels in 2007 succeeded because operational improvements and a market recovery allowed them to exit with substantial profits after a tough financial crisis. These cases highlight the importance of careful evaluation and resilience testing in any LBO model. Michael Dell's decision to partner with private equity investors and take Dell private through a leveraged buyout is a great example of how this model can work successfully. By doing this, Dell was able to step away from the pressures of public markets and focus on restructuring and strategic transformation, which strengthened the company before it went public again. This shows that the success of an LBO isn't just about the amount of debt taken on, but also depends heavily on good operational management and timing. The benefits of an LBO include enhanced equity returns, since debt can increase gains when the company performs well and reduces debt over time, and tax efficiency because interest payments usually lower the company's tax burden, improving cash flow. Additionally, managerial incentives play a big role, as management often gets equity, aligning their goals with investors and encouraging decisions that boost performance. Private ownership also allows a company to make long-term strategic moves without the pressure to deliver short-term results demanded by public markets. On the downside, there is significant financial risk involved, as taking on too much debt can raise the chances of default, especially if the economy takes a downturn or revenues fall unexpectedly. So, while LBOs have clear advantages, they require careful execution and timing to succeed. In a leveraged buyout, heavy debt loads can limit a company's ability to invest in growth, innovation, or acquisitions, which reduces operational flexibility. Additionally, rising interest rates increase the cost of servicing debt, which can lower equity returns and affect the overall viability of the deal. The success of an LBO also depends heavily on favorable exit conditions. If market multiples contract at the time of exit, even strong operational performance may not be enough to maintain expected returns. Ultimately, making an LBO work requires a delicate balance of leverage, stable cash flow, operational improvements, and realistic exit strategies. While LBOs can offer significant advantages in capital efficiency and amplified returns, they come with substantial financial risks that must be carefully evaluated through detailed modeling and scenario planning. The most successful transactions are those that are conservatively structured, supported by resilient business models, and led by experienced investors with clear value creation plans. When done right, the LBO model is more than just a financing method. It's a comprehensive framework that combines valuation, risk management, and strategic execution, with feasibility analysis at its core to ensure success. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.